Welcome back, YouTube. So I'm doing a state of the market update because we have a lot of conflicting data coming on. We see that eggs are escalating to the moon. We see that there's some discrepancies in the job reports because this is the most important thing going forward. Because I know that the Federal Reserve uses that as a measuring stick to kind of gauge their aggressiveness with these rate hikes and inflation. And this is a very interesting thing because we've seen some conflicting data before, and it's been said by several economists that the Feds are being a little over aggressive and just kind of should pause to kind of see the rate of inflation to see for what it actually is. And now we're seeing some revisions here or some studies coming out that actually support that evidence. And you can see here, it's a study by the Philadelphia Federal Reserve said that roughly around 10,500 jobs were created the second quarter of 2022. But the National Statistics Bureau said that it was over a million during that same point. So we're talking about a discrepancy of around 990,000, which is huge. This is not a marginal error. This is huge. And I think the biggest thing is what we're seeing is they're counting all new jobs as well, all jobs that are technically being taken off of the market as new jobs. And what they're not counting is the fact that people are taking on multiple jobs, two jobs, three jobs to make ends meet because of the inflation, because of the imbalances, supply chain shortages and stuff that we were having back then, a lot of good stuff that was happening. People were taking on additional jobs to kind of make ends meet. And they're counting this all as new jobs, as economy strength stipulations and stuff going on, saying that this is all a measuring stick for how strong the American economy is. Therefore, they can handle these more strict, aggressive rate hikes. And that turns out to be very disastrous for us if that is, in fact, the way that they're counting things, because this is going to lead to potentially a lot of what the economists are saying that we're in a position to have a mass correction later this year. This can lead to mass aggressiveness when it comes down to pretty much a spiraling effect. When it comes down to inflation, we see that the real estate market peaked around like May of last year. We see that the stock market has been declining for the last couple of years. We've had some bear market rallies and stuff like that, but nothing significant to kind of gauge like a turnaround or a reversal or something like that. We don't have any hardcore evidence to kind of say that, okay, things are turning around. So that's going to be a measuring stick that kind of we're really going to have to wait on to get confirmations in the macros for. So even when we see things like the shortages and stuff like that, whether that's with like eggs, I know I made that in the title, but I made a few posts on Twitter jokingly about the price of it, but we're seeing the ripple effects of what a supply chain shortage looks like. And if you look at you go to some of your local grocery stores and stuff like that, you'll see at least in my area, you'll see that they're even limiting the amount that you can get to two per customer. This is really a real world example of how quickly things can get out of control. And when it comes down to investing, I wanted to correlate this because when we look at the opportunities and we say that, oh, okay, well, we're looking for a pivot or U-turn for the Fed, and should we start being aggressive and stuff? So long term, when you're looking at investing, because I know inside of my group I talk about trading and options and stuff like that, if you're investing long term, these are great prices. If you're trying to scalp or swing, you're probably going to have to wait to get better entries. There will be some market rallies, bear market rallies, relief rallies, and stuff like that along the way. But this does not mean we have bottomed out just yet. And I do believe that we will more than likely see a pause or some type of correction after Q1 of this year. And then we'll kind of be able to better gauge the state of the economy, state of the market, so we can make more strategic decisions when it comes down to long-term investing. Because when we start seeing these mass corrections here, like 10,500 to a million, that's a huge gap. And if the Fed is making that huge marginal miscalculation month over month, this means that we're more than likely going to see some strength in the other direction, saying that, okay, we could possibly see a downward spiral and kind of get some kind of have the market kind of turn against us even more of an aggressive way and see some of that downward pressure, which for those of you that are prepared, that'll be a great entry for you guys as well. Let me know what you guys think. Let me know if you think that the Fed is calculating the numbers right, or if you think that they're pretty much misquoting it for people taking on additional jobs. And another thing is, we know that the Fed miscalculates a lot of these numbers, because even when we think about the way that they calculate unemployment, like I think it's like 3 months or something like that, and you fall off and they no longer calculate it, something crazy like that. So it's the Federal Reserve. It's the same way that they calculate inflation. They always got their own special way that they use to come up with these numbers. So it's nothing that's unheard of. But just let me know what you think in the comments. Keep an eye out for these indicators on these Fed meeting CPI numbers over the next couple of months, and don't eat too many eggs. I appreciate all of you. Like the video, subscribe to the channel if you want to hear more, and don't forget, check out Moomoo, where you can get up to 15 free stocks by opening up a new account. I appreciate all of you, and I will see you in the next video.
Try it.